discussion here as Intel was down quite a bit, about 3 1/3. Let's revisit that story because it just seems like every time anybody from that company says anything, Caroline, the stock basically goes down.
Hey there, Oliver. Yeah, you were talking about kind of a split market. Chip makers were also really split. The SMH ended up closing down modestly lower. You mentioned NVIDIA obviously didn't end up closing the day higher, but we did see gains for AMD, Qualcomm, Broadcom, Micron, TSM, so tried to rebound from yesterday's sell-off. But Intel not only closed lower, but actually added to its losses as the day progressed. We talked about some headlines circling this morning, and then the CFO spoke at the Citi Tech Conference, and it didn't seem to appease investors at all, despite the fact that Intel shares down more than 60% year to date. And basically nothing that CFO said actually gave a boost to shares. In terms of some of the intel that we got, actually, no pun intended, but now I'm realizing the pun. David Zerzner said there's no stone left unturned as the company considers its cost cuts. We know they're in the middle of a $10 billion cost-cutting program, which includes 15% of its workforce being slashed. They said that those cost cuts will be done by the current quarter earnings release, and the company will see most of the savings from the cost cuts in 2025. Meanwhile, we talked about this morning that Bloomberg report that the CHIPS Act funding for Intel and the plans were in grave trouble. There are growing questions about when and even if Intel will receive those funds. The CFO said that it's unlikely, or that they're not likely to see the money until the end of this year. So, obviously kind of not necessarily in line with never receiving the money, but pushed out till later this year. And then when it comes to the foundry business, Intel said it will begin to generate a meaningful amount of revenue from its contract chip manufacturing business in 2027. So have to look a little bit further out. Intel shares ended up closing down more than 3%. So now down 12% this week alone.
No funds from CHIPS Act till into 2024. Cost cuts realized in 2025. It's 2027 talking about what's going on. I'm in the intraday charts here, we're in the middle of the thick of it right now. They're talking 2027. It seems like a long ways away, KG. It doesn't seem like anything that's going to be particularly inspiring for Intel to turn around.
Yeah, unless they bring a new product to market here. And now, obviously, there's been some rumbles about that and how they're going to be able to potentially be able to match or try to compete.
While they're laying everybody off?
Yeah, well, you never know, right? Sometimes the R&D items, they don't get released until you actually have a viable product. So I think that would probably be the only turnaround story. Or if you do see a meaningful change when it comes to their balance sheet as well as their expense management strategies. I mean, sometimes the market is going to pay a premium for that, and we're just kind of waiting and seeing at this point. But it's an unfortunate situation here because they actually do have a very large exposure when it comes to their foundry business here in the United States, and that was really the cornerstone when it comes to the CHIPS Act. So I'm not sure if there's going to be more government funding in order to try to move that along, or if we are going to see maybe a little bit of sell-off when it comes to some of their assets.
Yeah, fair enough. It seems like they're still turning over stones and looking for ways to do that. So maybe it means more layoffs, maybe it means spin-offs. All seem like fair possibilities here. Kevin, you're looking at the energy companies. Let's talk about that real quick. As crude oil's been under some pressure, the stocks have held up a little bit better. But obviously still downtrending too.
Yeah, and so we have a chart that has the XLE as well as the 3-2-1 crack spread, and that just really measures profitability for oil companies, especially when you're looking at refiners. It's taking 3 barrels of oil, churning out 2 barrels of gasoline, and then 1 barrel of diesel. There's other types of spreads, but this is kind of the most popular one. Okay. And one thing to just kind of note here, Oliver, you're starting to see a massive divergence where the profitability when it comes to refining activity per barrel is actually continuing to move to the downside. In fact, we actually hit a low for today that really matches February of 2021, which is when we were coming out of COVID-19. And the reason why I bring this up is that the valuations for a lot of these companies are moving to the upside. So unfortunately, it does look like we might be on a collision course here when it comes to earnings for a lot of these energy companies. So just be mindful of that kind of going into the next couple of months here. They can kind of trade on its own. It's going to trade on the technicals as well as what's happening in the industry. But it seems like a lot of energy investors have discounted the fact that the the commodity itself has fundamentally broken down, and the profitability levels are going to be probably at one of the lowest levels that we've seen in a very long time for these energy companies. So be mindful of that, as not only just the internal valuations that we usually would measure, like forward PE, but it's also the product valuations as well that seems to be very disconnected from these stocks right now.
Okay, all right, good stuff, good context there. All right, well, we do have some earnings here this afternoon. We got HPE, which we did talk about earlier this morning, Kevin and I, and we've been talking cloud companies all week, Caroline, with this kind of whole cohort, the main part of the reporting season right now. The shares have been all right, not great. Right now we're looking at numbers that are improving. Their fiscal year adjusted EPS outlook has been raised by a couple cents. They saw $1.85 to $1.95. Now they're saying it could go as high as $1.97 and no lower than $1.92. So that's a really nice shift in the profitability range higher for the fiscal year expectations. On the next quarter, for the fourth quarter, seems like their range 52 cents to 57 cents on the bottom line, roughly around the 54-cent estimate. Maybe that could have been slightly better, but their trailing server revenues were about in line, maybe a tiny bit lower. I mean, it doesn't seem like a bad report. I could see it kind of going either way. The initial move was down, but now it's coming back up, Caroline.
Yeah, and speaking of the trailing numbers, it was a beat on both the top and bottom line for the third quarter. Adjusted EPS at 50 cents per share came in higher than the 46 cents that analysts were looking for. Meanwhile, revenue was expected to grow a little more than 9% to $7.64 billion, came in at $7.7 billion, so a slight beat there. You talked about the full year adjusted EPS outlook. Previously, that was at 185 to 195. So as you said, that's been boosted a little bit to 192 to 197. Not seeing much of a boost, though, to the stock price right now. It closed down about 1.5% heading into this report. Seems like it could be adding to those losses just a little bit right now. I believe you said for Q4 guiding for 52 to 57 cents on revenue, 8.1 to 8.4 billion dollars. So the expectation for revenue was about 8.15 billion.
That's
so
pretty good.
Even that, especially the high end of that, is quite a bit higher than what analysts were expecting. This is a stock that, you know, some have said has been kind of an overlooked AI play, but
Agreed.
The majority of analysts, about 70%, stay on the sidelines. And JP Morgan did say that, you know, NVIDIA's strong data center revenue really bodes well for a company like HPE, and it looks to be the case, but it doesn't necessarily look like they are going to be a huge beneficiary in terms of stock price, at least from what we're seeing right now. Keep in mind, shares were up about 10% year to date heading into this report, so it's not that expectations were completely low. But let's see what they have to say in terms of commentary, because seeing a little bit of weakness here following a beat.
Yeah, it's a pretty good trajectory. It seems like they're on growth-wise after reporting negative sales contraction in the latter half of last year. And then the last quarter, they got to single-digit growth. Now they're at 10% net revenue growth. So that's basically the AI kind of wave they're riding, KG, right?
Yeah, and that's it, unfortunately. And that guidance that you're kind of talking about when you're looking at the adjusted earnings per share for full year, I mean, that's all expense management, and they're really calling that out. Server revenue, when you're looking at the that business, you talked about it, 35% up year over year, but the operating margin within that business is really sitting at around 10.8%. This time last year, is sitting at 10.1%. But if you're looking at Intelligent Edge, profitability actually declined when you're looking at the operating margin. Hybrid cloud, the same, and then financial services, which is a very small slice of their business, for the most part, actually did see a decent gain there. But once again, it's maybe 10%, if that, of their overall revenue mix. This is an expense story that they're really telling. The top line growth, and you're looking at AI, seems like it's already been baked into the stock here. I didn't see any commentary that really wowed the street when it came to any type of updates for AI. So let's see if the stock's going to be able to hold on. We were expecting around a 7.1 to 7.7% move, implied move, either to the upside or a downside for the options market. Let's see if we're going to be able to realize that, but nothing that really, you know, is really like positive about this report outside of the street's expectations. You know what I'm saying?
Pretty much stuff that was understood and expected, which again is kind of the burden now that you've had such a good, you know, trailing year for still a bunch of these companies that have now come off significantly from the highs. Unfortunately, market's basically saying that they maybe need to come off a little bit more. I mean, look, HPE earlier this year. At one point at the lows is at 15 bucks, so it's still got some room to work with, but it just seems like the I don't know, the expiration dates like arrived to some of like the earnings driven AI pops. It's just we're not really getting many right now. Appreciate it, Caroline Woods. Thank you, Kevin Green.